All right, Jeanette, thanks so much, and good morning, everybody. I'm thrilled to be with you. I want to talk about these FANG stocks and particularly how we trade options on FANG stocks. I know you probably are familiar with the term of what the FANG stocks are, but if you're not, we're going to walk you through that. Part of my objective in any training that I give to traders, whether you're new or experienced, is you want to keep it simple. You want to keep it focused. Sometimes I have a hard time after having traded for 25 years keeping up with what some other folks are doing and jumping all over the place with 10 different things that you got to look at. And I'm all about, okay, how can we boil it down to like one simple indicator, one simple methodology? It doesn't mean that's the only indicator that I use across everything I do at Big Trends. We've got a variety of portfolios for different objectives. But if you're looking for some growth, we're going to talk today about how I like to leverage the FANG stocks using weekly options. So whether you're new or experienced, I think you're going to enjoy this next hour. And we'll give you a lot of case studies so you can actually really dive into the charts and see what's going on here with these FANG stocks. I'm glad Selwyn agrees. Keeping it simple makes a lot of sense. Quick disclaimer, reminder that everything we're sharing with you here today is for your information and education only. Nothing we're talking about here should be considered a specific recommendation of buy or sell any particular security. And of course, you know that ultimately you are solely responsible for your own investment decisions. And of course, here at Big Trends, my staff and I are not responsible for any trades that you choose to make, and ultimately know that not all Big Trends products or services are going to be appropriate for all traders and investors. You got to consider your risk level, so always factor, what's comfortable for you and trade with your risk capital as you build up. Now, bottom line is that we don't provide any personalized financial, tax, or legal advice. We send out all of our investment research to all of our FANG options traders at the same time through real-time email and now real-time text to your smartphone. Then you decide how you want to use it and consult with your tax advisor before make any investment that's going to impact your unique tax situation. So I'm going to walk you through today what are FANG stocks, and then more importantly, how can we use weekly options to get what I consider to be intelligent leverage. Let's face it, leverage can be a double-edged sword. You've got to manage that risk when the trade's not going your way. And I'm going to share with you my number one indicator that actually I think does a really clean, simple job of finding a trend on a short-term time frame. So we're really focused here on usually the next 2 or 3 sessions. So it can be the same session. It could be a little longer than that, but definitely it's going to be under a week. So it's going to fit for a little more active trader lifestyle. But at the same time, it's not something you have to watch every moment of the day. So we're going to talk about the number one time frame you should look at. And more importantly, why I love the weeklies on the higher dollar stocks, why you actually get more bang for your buck trading options on high dollar stocks. And then you just have to know how to manage the risk. So I'll walk you through both. Now, I'm getting a lot of people that are telling me, kind of like our last presenter, about how they'd like to create more of an income stream. So I'm also going to walk you through how you could actually take this FANG strategy and actually pull money out of your account consistently, and a couple different ways that you can do that. So we're going to walk you through all that today. So we've got a lot to cover, so I'm going to get rolling. Now, if you're not familiar with this term FANG, it comes, I think Jim Cramer initiated the term. Got to give credit where credit's due. It comes from the first letter of these key stocks. Facebook, of course, ticker symbol FB. Amazon is the traditional A. We've actually added in an extra bonus, which you see below. Netflix is the traditional N. And then Google, which is actually now, they renamed themselves Alphabet, but everybody's, you think of Googling a search term, not alphabeting a search term. So we still use the G for Google. And then we threw in a fifth stock because it tested so well, which is Apple. So it could be FANG or FANG up, but basically it's the big 5 tech stocks that are really driving a lot of the market's gains. In fact, I saw an article recently in Financial Times that said that as of a couple of weeks ago, 80% of the S&P 500's gains were driven by 50 stocks. That's 10% of the S&P 500 was driving 80% of the gains. Now, if you haven't been paying attention to the market this year, tech is driving the train. After the election last year, financials drove it for a while. Financials have been coming down. Energy's been coming down. It's the tech stocks that have been rolling to the upside. If you haven't been paying attention, we'll show you a variety of charts of what's been happening here. So now if you trade any of these stocks, like Google and Amazon are like $900 plus. So if you bought 100 shares of Google or Amazon, that would cost you $90,000 plus. I don't want to commit that kind of capital, especially as a short-term trader. Why buy a stock when I can lease it for a short-term period, get the proper trend phase movement, and then move on to the next good trend to come in one of those other names? The other good benefit of this is I don't have to look at hundreds of stocks. I don't have to look at way too much stuff. I can look at 5 key names. So I don't even have to set up a scan in this case. We do have a scan program for those that want to filter through a whole variety of different names. But that's a lot of work, and so this simplifies it down to say, okay, let's keep it simple, the top 5 big tech drivers. Now, when we started actually sending these trades out via real-time email alert back in August, what we did is we said, okay, let's see with this system how well we do. And so we had a little internal test for a while, and then we launched it out to the public. And interestingly enough, we grew that model $10,000 portfolio here. This is just buying options now. We're not trying to sell premium, but I'm going to tell you how you can convert this into an income-generating strategy here in a minute. But basically what we're doing is we're just keeping it real simple. Just one leg. That reduces your commission costs. So here we'd be buying the Netflix August week 2 89 strike call. That means you've got a right to buy Netflix at $89. It's obviously a lot higher than that now. A lot of these are. But basically, what we're trying to do is look at something that we think we can get, kind of like our AJ was saying on the last session, kind of more of a stock substitute where possible. What's happened is because Google and Amazon are now $900 plus, we're probably going to have to buy them a little bit closer to the current price of the stock, because we want to always keep these at $10 or less, meaning that if you buy an option for $10, that means that you control Amazon around $76,000 worth of Amazon stock for $1,000. $10 on an option contract controls 100 shares. That's 10 times 100 equals $1,000 invested. We said on these model portfolio results we would never commit more than $1,000. So that means you can at least get one contract when it's priced at 10. If it's at 5 or less, you can get 2 contracts, and if it's at 3 1/3 or less, you can get 3 contracts. You see, most of these are in the neighborhood of between $4 and $8. So, that's just kind of the way that it works, where you're not going to get a ton of contracts, but you're still getting really awesome leverage. If you pay $1,000 for something that you control $76,000 worth of stock, you can do the math. You're getting a 76-to-1 kind of potential leverage ratio there. Then you just have to manage the risk. Now, what you notice is it's not perfect. There's times where the strategy is not going to work. You can see some of them trades through April here, where you can see, how we did there. Grew even just in the month from March to later April. You can see we grew from 11,888 to 13,344. Okay, so you say right there in that month, that's about almost a $1,500 gain. 1460, I guess. And so the bottom line is that, okay, that's before commission, so take your commissions into account. The commissions have come down tremendously. I dealt with one of my coaching students recently who was still at one of the full-service brokers, and he was paying an insane amount on every trade. I switched him over to one of the discount brokers. I saved him more than 90% on his commissions to basically go to one of the more, discount-oriented brokers. There's a lot of good ones out there that can get you in and out for, in the neighborhood of anywhere from $10 a contract to as little as $1 a contract. $10 a ticket down to $1 a contract. So commissions have become a very small factor if you're using one of the right brokers. If you need help with that, you can contact us. My associate Chris Sayers in with us. He can get you more details through our 800 Big Trends toll-free number. But basically, you see, okay, so how have we done since? You say, okay, so let's just look since that point here. Let's just quickly drag that on here. This is actually exactly what we expect on that portfolio. So you see, Google was from the 48% gain. We had a couple of losses, and we try to keep the losses in the neighborhood of about 25 or 30%. Every once in a while, it might slip a little bit more than that. Apple was down 33.8. Okay, if you got bummed out about Apple there, that was a put actually, didn't work, and then we flipped it around in a couple of weeks, early May, you can see about 2 weeks ago, we had Apple for 102% win. Then we had some small wins, a couple small losses, and this is kind of typical that you're going to see on this system that, when you're wrong, you're not wrong for long. You're going to hop out relatively quickly. If you're right, it's going to basically make you keep riding, and this is where I'm going to teach you about this indicator that allows us to ride with confidence on a short-term trend. Like I said, a day, 2 days, maybe 3 days. You can see almost all these. This was a 3-day one on Amazon that made 169% on the top. and then you can see some of the other ones. You might even get stopped out the same day. So if you do, don't be surprised if that happens. We're always sensitive to, of course, not having too many day trades. So we don't want to have more than a couple of day trades typically in a 1 week span. So you'll see that that won't happen very often with us to get in and out the same day. But if we have to, we will. Okay, so you see that's going to mean continued growth in the portfolio over the past month. Since mid-April to mid-May. So we're going to go on and now kind of just overview for you a little bit more about the system. Of course, you've seen some of those gains already, so I won't spend too much time on this. And, of course, we've had bigger gains now with Apple, more than 102%, our biggest Apple gain since August. You can see, of course, Amazon was 169% and a whole lot more. But, the key is, of course, how does your equity growth look too? So every once in a while you're going to have a little dip. This is why it's important. This is one of the most important things I guess I could try to hammer home. It's not just that you understand this methodology today, but also that you understand do not overcommit your capital after you get a big score with this methodology, because that's where most traders go wrong. They think they got it figured out. It's going up, 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 up. They start plowing in way too much capital, and then they get whacked. And then what happens? They give up. What we want is you to take a more consistent view of this and say, okay, look, there's going to be months where you give back a little bit, but you see, when we've had little drawdowns in a month, we've gained it back very quickly and then some on that latest run up there in March. So, and it's gone even further since. So I just didn't have time to update it. But basically, if you look back over those prior 8 months, I think we've improved our ratio beyond 75%. But you can see as of this point, 6 out of 8, 75% of them were profitable. Now, that average through March, it averaged a $420 gain per month in gross profits. Now, again, take your commissions down. But, we're doing in the neighborhood of, you can see from what we showed you before, somewhere probably around 8 trades average per month. Okay, so you can factor your commissions out of that accordingly. And like I said, if you're paying too much, if your commissions eat that up, you need to get to another broker. Okay, so basically, what we would say is, okay, if you started with a $10,000 portfolio, what if you were just taking out, say 2% a month? I know, some people will claim they can do a lot more. My experience is if you're taking out more than 2 or 3% a month, you're probably going to have phases where then you have a drawdown and then you can't take that out for quite a while. So, everything sounds good until you run through some of these more aggressive methodologies where they run up quickly, but then they run it down quickly. We want to make sure we hang on to as much of the profits as we can. But you can see if you were taking out even just $200 a month, you can see you'd have a leftover in the bank for the next month. This would be the save some for a rainy day approach. You have $65 left. Now you can see, of course, if you took out $200 in September with your $65 plus another $690 to go, you'd actually have, of course, $755 left, right? So you'd have this huge reserve that you could keep drawing from. But one of the reasons that I tell people, whether you're taking out 2 or 3% a month, you can see if you're taking out 3, of course, then, of course, you're going to have a point eventually, even with the reserve, where November you give back some. So in this case, if you go to October, you took out 200, you got 380 left. That would put you in the neighborhood of about over 1,100, about 1,135 in the bank. So now, if you took out 200 in November, you said, you know what, 200, you gave back 560, that's 760. You're still ahead of the game here by about $360 or so, 375, I guess. So it looks like about 355 actually. So basically, you say, okay, roughly 350 you're ahead of the game. Then you're back in the positive, small give back in February, huge gain in March. So basically, the thought is, okay, that's one way you could do it. The other way you could do it, that's a lot simpler actually, is you could just take out the monthly gain and but the number one thing when you do this is you've got to try to protect your original capital base. So if you were taking out 2.6% in August, 8.9% in September, 5.8% in October, and then you go, oops, now we're down from 10,000 to basically 9,440 if you lost 560 in November. So you can't take out anything if in November you've got to make that up. You can see you effectively made that up in December. You were $6 short of that after December because you'd still be using just $1,000 a trade. We're never holding more than a few trades open at a time. So even on a $10,000 portfolio, you're going to have a very large cash cushion here. Okay, so essentially what we're saying is, you know what? You made that up. Now, so you had basically effectively a flat November-December average, and then you're back to 5.8% in January. Now, you gave back 148 in February, so you know what? You've got to take that 148 out of your 1194 and say, okay, the next month you're basically making about $1,050, $1,046. So basically say, okay, then I'm making more than 10% in March. Okay, so if you can stomach that you just don't touch your portfolio if you're giving back a little bit, but you keep trading the same $1,000 a trade in this example, you can see how you could be pulling out a heck of a lot of income the majority of the time. I'm not going to claim it's going to be every month because there's going to be occasional down months. But the beauty of this methodology is that the losses are relatively smaller, the gains are relatively bigger on average. The way people mess it up is they tinker with their allocations, and they way overcommit after a run up, then they get knocked, and then they give up, or they undercommit after that. So you've got to be consistent. That's the number one thing. Now I'm curious, if you said here, okay, what type of trader are you? Just type it in the chat box. If you're a day trader, 1, even we call it quick trader, 2 days, type the number 1. Swing trader, more like 3 to 5 days, type the number 2. Just kind of curious where you're at, what our crowd's like. Position trader would be like more like 1 to 4 weeks, number 3. And then more like active investor, longer term approach, 1 to 12 months, and then buy and holders, number 5. So most of you are 1, 2, or 3. We've got a lot of each, actually, so a nice mix. And the beauty of this is that it kind of fits, frankly, more in the day to swing trader category. But like I said, I would almost say that we're kind of 1.5. We're kind of in this. I should have had a 1.5 category. We're kind of in this like 2-day sweet spot. Maybe 3 days, maybe 1 day. Okay, so that's kind of the way the system falls. Now we have other products if you like to more do out to a week or even a couple weeks. We've got other things that can hold it a little bit longer if you prefer that. But this is geared at, hey, let's not hang around too long. Let's only hang around when we really want to. So I want to talk about our tools and our indicators and actually start getting into some charts so you can visualize this now. So from the standpoint of what we're using here, we use a lot of platforms. You don't have to have these platforms. One of the cool things is that my indicators are focused where you can actually get all of them through TradeStation, Thinkorswim, and Metastock. We call that our toolkit. If you're really an in-depth trader, you want to have not just these tools I'm going to talk about today, but really all of the big trends tools for a lot of strategies. Now, what we're going to talk about today are, okay, the indicators we use, of course, we use a nice simple moving average as a longer filter on an intraday chart, but then we use the directional movement lines that Wells Wilder developed. This is the same guy that developed the Relative Strength Index, or RSI, that you're probably real familiar with. Most people are familiar with DMI and ADX, but some aren't. And what we're talking about today in particular is ADX, the average directional movement. So that's going to be, as we put these pieces together, we start learning, okay, what the average true range means and how that gets factored into the ADX line. The ADX line is the trend line I want you to follow. This all creates what I call my trade funnel to find these trends within a short-term time frame here. Now, what is DMI? It stands for Directional Movement Index. Now, Wilder's contribution here to the trading landscape is pretty immense. I mean, he's had a lot of key indicators that he's developed, and I've developed indicators, but you know what? We test everything, and when something tests well, I don't care who developed it, I want to be able to help my clients at Big Trends take advantage of it. So what we found here is that Wilder's contribution to the concept of the range for a stock, he called it the true range, should include the amount of a gap. See, before, people used to say, okay, well, if you've got a typical, bar chart here, you're open down near the lows, you bump around there, you rally up, and you finish near the high of the day. And then the next day, say you get a gap, and it has kind of your doji pattern for you candle followers. It kind of rallies, tries to go up, then comes back down. What Wilder was saying is that most people would call the typical range on that second day, we'll call it R, okay, just the high to low range on that second day. And what Wilder was saying is that, what you got to do, you got to encompass that range, but you also got to encompass back to the close of the prior day. So essentially, Wilder's a bigger true range actually encompasses the gap as well. So he's saying there's a broader range there than just that particular day's high-low. So essentially that becomes important because now you're starting to factor the gap, of course, in this case, positively as more positive directional movement. And by directional movement, Wilder's looking at the net new movement that you're getting in terms of higher highs for positive directional movement and lower lows actually for negative directional movement. But if you're making higher lows, of course, that would be less and less negative directional movement. That's the kind of pattern that actually will set up more of a trend when you get higher and higher highs, higher and higher lows. We call that, of course, an uptrend, right? And likewise on the downside, when you're getting a lot of new lows, that means your negative directional movement is going to surge, and you're not making any new highs. Your positive directional movement is going to drop. So that also is how we're going to show how that true range actually turns into the average true range to show the actual total movement you're getting in the period of your whatever you're looking back. And so now with average directional movement, what ADX does is it takes those DMI plus and DMI minus lines, and I've got a chart coming here to help you visualize that. It'll be worth a lot more than these words, I know. Just trying to give an overview of what we're doing here. It's saying, okay, you know what? We want to look at the gap between the width, if you will, between the DMI plus and the DMI minus lines. And we want to say, okay, when you're getting an uptrend, the DMI plus is going up, more and more positive new highs, right? And the lack of new lows means the DMI minus is going down. So that width of the lines between the lines is actually widening. And so the ADX will actually pick up when you're seeing that widening differential between those two DMI lines. It'll actually pick up an ADX rising trend, okay? So that is something that we want to take advantage of. So, and then the beauty of this is that you can basically normalize this across any stock to compare apples to apples or Facebooks to Facebooks because of, the fact that divide the directional movement by the true range to get you basically a relative percentage of how much trend movement you're getting. Let's look at some charts here. And basically, so for example, with Google, parent company Alphabet, but we just call it Google. Bottom line is that if you in this example here, what are we getting into here? What we're seeing in this case is you're seeing that this is the DMI plus line here on the blue line, okay? The DMI minus is in red, and then I've kind of got the ADX here starting to go up there in green. And what we're looking for, actually, I've kind of obscured it slightly, not on purpose, but basically that what we're looking for, and you'll see it some of these other charts as well, is that the ADX is rising from a low level. You see, compare this to where ADX, you can't even see it because I've accidentally covered it up here with our FANG Options Trader special to get you in for just try it for a month in a little bit. But bottom line is that what we're seeing here is that we would stay away from this entire phase here. So literally I would X out any of this action and say, I'm not interested yet. Because even though it's holding, there is a moving average filter here, so the moving average is telling you that it's mostly positive, this light blue line on the upper panel. That's why we won't take a bear trade if it's above that moving average. But what we need to see is that ADX has been below both the DMI lines, and then it turns up. One of the interesting things is that a lot of people used to say that in the old literature when I was first studying trading back when I graduated from Duke and just jumped right into trading at the start of the 90s, is that a lot of people would say ADX isn't good for telling you the direction of the trend. And my immediate response to that was, we can fix that by saying, show me the DMI lines with the ADX, and I'll tell you which way it's going. So in this case, when ADX turns up, it starts to cross above, in this case, that declining directional movement line, we actually get our buy signal at that bar's close. And you'll see some other examples of that. Now, in this case, you can see it was happening right near the end of the day. So we're watching this thing literally into the final minutes, and we send alerts out real time. We try to make sure we get it out with at least 15 minutes to go before the close. So we need to see that turn happening by 3:45 in this case, which it did. And then we're saying, okay, buy the 802.5 call into the next week's expiration. So our usual weekly option strategy, which we're going to talk about weeklies in a few minutes, is we want to make sure that we're going out about a week here. Okay? So from this perspective, you see, okay, that when you're looking at this, you're going to actually say, okay, when do we get out? When the ADX actually rolls over. It starts to roll over here even by the slightest amount right there. So our exit's happening right there when ADX rolls over. I used to say when ADX rolls over, it's kind of a bend, or maybe it might hold here, but you can see it eventually doesn't. And with this strategy, we learned that we don't want to actually hang around too long. We actually want to make sure that that we need to focus on how we can go from this. Now, let's go ahead and update this screen here, but I mentioned that I overlaid that link by accident there, so I can't take that off of there. You'll see some other examples here, but the point is, what about ADX here, where ADX starts to turn up the next day? you see that it did come down for a little bit. ADX did rise, but ADX was not below. It needed to be down here. It needed to be below both of these and then start rising above that directional movement, and it needed to be down below the moving average area. Neither one of those. So you get two X outs there that would not allow us to take that trade. And you see a good thing, right, because it held, and then by the time you would get stopped out, you would actually be losing, especially if you held into the next day's gap the other direction. So we're very sensitive to gaps. We want to make sure that we have that powerful ADX working for us. Now, I want to show you an interesting example. We're going to show you a lot more charts, don't worry. But I want to show you an interesting example here where we have a situation here in which you can see that high dollar stocks can make you a lot more money. Okay, now, and subscribers, Richie, get the access to the settings and all that stuff. So I'll show you how you can get that access for very reasonable month-to-month starter price point here in a little bit. But let's just say each of these stocks, a $20 stock and a $200 stock, rises 5% in 5 trading days. Now, you say, okay, if I've got, I'm trying to match up about, okay, what each option I could get for what I typically would trade. If I go, in this case, just slightly in the money, you can see in both cases on a $20 stock and a $200 stock, I'm going to go about 2.5% in the money. So 2.5% of the money on a $20 stock is to buy the April 19.5 call. The $200 stock would buy the April 195 call. Now, we're assuming here that, okay, you're using relatively short-term options. In this case, on a $200 stock at 195, we might pay $550. So I would get 2 contracts. That would be $1,100. So I want to compare each one accurately. So if you go about a half point in the money on this one, it'd be about $1 entry. Means that we buy 11 contracts for that same $1,100. We use 1,000, but I'm just comparing the exact numbers here. Okay, so from this perspective, we look at this and say, okay, what would you make? Well, what's interesting about this is that you're really not getting in the money enough on the $20 stock, just going 2.5% into the money, because basically you still have a decent chunk of time on this one. You can see that our intrinsic, it turns out, is about 50 cents on the dollar. That means that our extrinsic or time risk is about 50 cents on the dollar. It's a 50-50 intrinsic to time ratio. Compare that to over here on the $5.50 option that's $5 in the money. That means that only a $0.50 is time value. Roughly about 10% of our option cost is at risk for time decay, not half of our money at risk. Now, in this case, we assume a 5% rise. So if the $20 stock, you can see, goes to 21, 5%, that means that by definition, the 19.5 call, we'll assume that both of them are at expiration, 19.5 to 21, that's worth $1.50. You paid $1, you're making 50%. That's before commissions, that's $550. Guess what? What does a 5% move do on a $200 stock? Takes it to 210, right? Not 21, but 210. What's a 195 call worth at 210? It's worth $15. You paid $550 for it. You only had 2 contracts. I know some people don't like that they don't get as many contracts, but what I like is that, okay, $550 goes to 15. That makes you 173% on your original $1,100. You turn it into $3,000. Because it's $1,500 a contract now times 2, $3,000. That means a gross profit of $1,900 on your original $1,100, 173%. So basically, you're saying, okay, that's the leverage ratio kicking in, and that shows you why I don't want to have more contracts. I want to just have more intelligent leverage, because, and the reality is that these Facebooks and Googles can put on 10 points in a hurry. Sometimes a $20 stock, it seems like it's a slow boat waiting forever just for it to get to 21. So my experience, even though it's the same percentage, is that these stocks can actually, the high dollar stocks can really heat up quickly. Okay? And one of the things I'm noticing, and I apologize for this, is I'm actually noticing that I actually have a couple of these overlays. So I want to take off, this next one here is an overlay so I don't mess it up here. So bear with me just 1 second, because I definitely value giving you the education. I'm not trying to obscure it. So just bear with me. I just threw those links on there. And let's go ahead. Okay, good. That one's okay. So let's go ahead and reshare that now. Okay, so next slide, another chart. There we go. Okay. So let me more clearly show you what we're picking up here. So remember, when ADX is down, and even a lot of people teach, by the way, that they don't want to trade until ADX gets over 30 or gets over 40. My experience is that's too late, that you're basically in a position here where you're really going to have a problem here. And you basically say, you know what? Let's get it when it's still fresh. So when ADX just barely starts to turn up here on this very first bar here, this is on Facebook, you can see we don't buy yet because ADX is turning up, but it hasn't crossed above that declining directional movement. In this case, the negative directional movement right there crossing the second bar. Now notice these are 30-minute charts. So it's possible that on any 30-minute close, we could have a signal. Usually these signals often happen early in the day or late in the day. I don't know why. That seems to be the pattern, but I kind of know why. That usually you're either getting a very early move and then it's falling through, or quickly it's not. And then also where you see some shakeout in the morning and then you see the market like it did on Thursday and Friday start to recover late. So that's possible too. But what we care about is, okay, now ADX is turned up above the declining direction movement. Remember what I said here. You've got the plus getting more positive. You've got the minus getting more negative. That means that basically you're making no new lows, right? You can see it on the chart here. And that we're just going up, up, up every bar. So we're not making any new lows. Even when here's what I really love about this indicator. Even when it kind of flattens out, you see it goes through this little kind of what looks like a little triangle pattern here. Even though it's flattening out midday, it's really not making any new lows, is it? It's not making any new highs either. You can see that the new highs is actually, the blue line starting to come down a little bit. But look at how the ADX is still going up. That's why, when people say, I only trade price action, I'm like, well, welcome to Whipsaw City. I don't like whipsaws. As a trend trader, I want to get the consistency and the trend and the sweet spot of the move, and I want to leave picking tops and bottoms to everybody else. I want to leave those fake outs. And I can't tell you how many big trend students I've coached that are like, yeah, I got nervous there and I sold some calls and then I gave up that upside the next morning. It's like one of those things where, you basically want to keep riding until the indicator tells you that it's actually rolling over. So it does start to roll over here in the green line there about the third bar. And it's still better than if you'd gotten out near the close the prior day. But now it's saying, okay, now it's uncertain what's going to happen. Now, here's an important other point. When ADX starts coming the other direction, a lot of people make the mistake because this chart looks like it would have worked, where they say, okay, when ADX rolls over, I'm going to flip, and instead of buying calls, I'm going to buy puts. Don't do it, okay? Because the DMI lines are still positive, and basically, we would call this phase more of a consolidation. I know some traders who look for range expansion versus range contraction. Obviously, the range expansion is back here where ADX is going up, up, up. Range expansion there, and then range contraction when ADX is going down. Now you say, look, here's another example where ADX went negative here back here near the end, and you see that ADX is starting to turn up here. You say, well, why didn't we trade the downside of that move? Well, we're still above the moving average. We've got it in red now on that one. And again, interestingly, if you see, it did trade to the moving average, and then it flipped, and by the time it started to roll over near the end, you're already giving back a big chunk of those profits. So we found that betting against those broader moving averages is a mistake. So you want to align your short-term view with kind of more of a position trade view as well. So it kind of gets a couple of time frames working in the same direction. Now, one of the things you may notice here is that, a lot of the options books, if you read about it, they mostly talk about volatility when they talk about options pricing. And to me, there's always been a missed opportunity, kind of what we often call the hole in the Black-Scholes model. You remember the guys that won the Nobel Prize for making the Black-Scholes model? Does anybody remember where those guys went right after they won the Nobel Prize, two of those guys? They went to a really big hedge fund. Anybody remember the name of it? Long-term, there you go, LTCM, Mike. Long-term capital management. Ironically, they were doing a lot of short-term strategies and using incredible leverage, and they blew up. They almost blew up the financial system. It was rumored back then in 1998 that Lehman Brothers was technically insolvent. It only took another decade for that to play out for Lehman. But basically, you know, at that time, Lehman and some of the others had sold a ton of puts to long-term capital and basically had to get a bailout from the Fed and a consortium of banks in the fall of 1998 to stave off the long-term capital management crisis. So the Black-Scholes people actually practically blew up the economy and the market, okay? So why? Because trends exist. Trends happen. Their model that they built all of Black-Scholes on said, you know what? Trends don't exist, at least not for any length of time. So they bet on what's called mean reversion, which means assumes that anything that goes up eventually is going to come down, and anything that goes down is eventually going to come up. So every rally they fade and bet it's going to go the other way. Every drop they bet that it's going to bounce back up. Well, you know what? When the Russian ruble defaulted in the summer '98, and a lot of other emerging markets started to sort of domino effect on the downside, like we saw a decade later in 2008 with the Great Recession and the financial collapse. Bottom line is that you see a situation here in which you clearly had a flaw in this model. So when you focus just on volatility and you're looking for really high volatility stocks, you're going to pay off for that, especially if you use at the money or out of the money options, because those are 100% time premium. So the solution that I provide here for our FANG options traders is we focus on strong trends for short periods of time so we don't lose much time premium, but more importantly, we also use, wherever we can, we use in the money options. And in the money to the point that even if I got one contract for, like I showed you before, $10, $1,000 for one option contract, that will often be the better choice than buying, $10, $1 options way out of the money on one of those FANG stocks, because then you got to get a huge move to see them start paying off usually. So these in the money options are going to get more bang for the buck more quickly. Now, like I said, with Amazon and Google over 900, we're still kind of focused on weeklies out to the next following Friday. So like right now, if we were getting a trade yesterday or say Monday, we could be looking at this coming Friday's expiration, but by midweek, we'll be looking at the following Friday's weekly expiration. So these give us some time to work with, but also really only trade in the strong trend phases, especially if you're buying options. You should not be trading slow trends. How many of you had the experience where you bought an option, you were right on the stock, and you still lost money? Okay? I'm actually raising both hands right now because early on in my trading career, that happened to me more than I would like to admit. I was going, why is it that I'm right and I'm not getting paid in my options? It's because I bought too much volatility. I bought too much at the money or out of the money, and I basically, therefore, needed a bigger move. I got a slow move. You need a bigger trend to offset the time erosion, and the in-the-money strategy will help do that. Now, here's an example with Amazon. This is one of those home runs I was showing you earlier. So, again, forget about buying it lower once you get the signal. Once we get the signal, we want to get in. So we will actually send out a real-time trade alert that will say, buy the Amazon weekly 852 call, and we'll say buy it up to a certain price. Now, the 870, we might have said buy it up to $9, but the 870 is the average fill price from brokers who automatically trade this. We've got a couple of brokers who can automatically get you in and out. If you're interested in that, just check with Chris Sayre, my lead consultant. He can get you more details on that. They'll do it for the same cost typically that you would do it on their platform yourself. So it's just a nice auto execution if you're afraid of missing out on these, if you're working a day job or what have you. So you can see here that you get in as soon as you get the signal, which is what? The ADX is coming off of a low level. We were stuck in a no man's land there, and now it's signaling to the upside. You can see it starts to go to the upside, and here's another example where this is what I love about this. 3 bars down right in the close. Why didn't we get out? Because ADX was going up, and then it just went up a little less slowly. It did not roll over. If it had rolled over more, if it had been probably down to about here, probably about 855, back where we got in, that would have probably gotten us out, because that would have started to bend that ADX down. As soon as that ADX bends down, we say bye-bye. Instead, you get a rocket ship the next day. Second day we're in, it's just up, up, up the entire day. Now, we were tempted, because this was kind of early on as we went live for subscribers, so basically we were tempted to say, hey, we're more than a double. Should we just lock it down? And I'm saying, no, we've got to follow the system. And I'm just sharing that we all get tempted to sell out of our winners too quickly. If you've been burned in the past by the markets, you're probably in that hair trigger cycle now where you're taking your profits too quickly and you're not taking your losses quickly enough. We help you turn it around and actually ride to big wins when they're doing what they're supposed to do, and also getting out quickly when it's not doing what it's supposed to do. That's the secret to trading success. You've heard it a jillion times. Let your winners run, cut your losers short. But this is how you do it when the rubber meets the road with a specific indicator like ADX. So you see into the next day, then you get kind of this sort of spinning action right off of that third day's open that we're in the trade. And basically you can see then it starts to dip and then a little bit more, and it's just barely rolling over. Now, this is a good example. I don't show the rest of the chart, but actually we got out there. It kind of bumped around that day. It actually ended up rallying even more. So this is why you don't bet the other direction, because the DMI lines are still positive. It's just that we've lost that best trend phase. So we only want to be in for the best trend. Now, like I mentioned, this stock substitute approach, where we can, gives us the ability to control that underlying FANG stock for a very tiny percentage of the stock cost. Why would I ever buy when it's much cheaper to rent, when I know I'm not going to be in those stocks for the long haul? I'm just using them for the very short windows where the trend is really on our side. So like I said, Google shares now more than 90,000. Same with Amazon on 100 shares. One call, no more than $1,000. Now you're at 90 to 1, and not just 80. Now 90 to 1 leverage on those names. And Rosa, the ADX is green. We'll show you some more charts before we're done here. I'm on time. Okay, I got a little time left. Okay, so basically, the number one thing here is that it's very important to control risk. So like I said, even after nice winners, do not overcommit your capital. Be consistent in your capital allocation. Even if you say, gee, I've got some extra cash sitting here doing nothing. Because basically, I don't want you to get too high or too low. I want you to basically be able to ride steadily. And also, when you do have a loss, I want you to be able to take it immediately. That's where most people get messed up. They think, well, they're quality stocks. You said they've been leaders all year. Don't they have to eventually bounce back? You start playing that rationalization what-if game and not getting out, and basically you get stuck with a much bigger loss far too often in options. So that's where most people have gone wrong buying options, is they don't take their exits, and then they go, yeah, options buying doesn't work. Well, it doesn't work if you don't get out when you're supposed to get out. Okay, so basically, but it does work nicely. It has historically for us. I expect it to continue. I can't promise any one trade as a game, but we're playing what we consider to be a probabilistic edge, knowing that past performance doesn't guarantee future results. But, that's why I say, okay, control your risk, and I think you're going to see that you can stay with trades whether they had. If we had a loss on Apple and we come right back to Apple, you've got to be able to take that next trade just the same. That's where most people mess up, because you might get whipped on one and then for a quick loss, and then you get a bigger gain that you leave on the table because you said, I don't want to get whipped again. So that's the kind of thinking that you have to have here. It's just a nice manageable amount of risk for you, so that way it's comfortable enough for you that you can just follow the system and give it a chance to do its thing month to month and ultimately year to year. So another example on the downside. We've showed you some bull examples. How about a downside example? So here's one where Google was just starting to break down below this moving average. So right when we got the signal, it had to be below the moving average. It closed just below there. You can see we're getting our ADX cross right there. This is right near the end of the year, and basically you can see an example where, again, we're only going to get one contract there. And in this one, it was kind of grinding slower to the downside, and then you can see it, once it started to bounce back up, we had to hop out. And we in retrospect, this one we got whipped a little bit because it went down more before it came back up. But if you're holding and hoping, and then it rallies all the way back up, you're going to give back too much of your profits. So in this case, it was only an 18.9% gain. But, hey, in a couple of days, a holding period, that still can compound real nicely. But you see, when ADX starts to cross back up that next morning, don't take it because it's coming from too high of a level. So if you were getting in there, I'll put a question mark on it, you think I'm making money, you come in the next morning and it's absolutely just going haywire against you, right? Because you basically got in when ADX was too high. So especially as a short-term trade. You know, a lot of people say this market's been really choppy. Not for us. We've been really loving the benefits here. Now, if you're new to weekly options, of course, we just had the traditional monthly expiration this past Friday, but we still use those monthly options in the final week or 10 days of our life as effectively a weekly choice. Now every single Friday here, you've got a weekly expiration. And especially on these big names, they actually have weeklies already listed out for the next month. So each of the next 4 to 6 weeks, they've got weeklies out there. So, you know, typically they're listed on a Thursday and most stocks to expire the next Friday. But these big names already have multiple weeklies already out there. And this gives us opportunity to take advantage of events. But you know what? We do not trade in front of earnings. We'll trade after the earnings. We'll get rid of that volatility. We'll let the trend start to assert itself in either direction. If we got the right setup, then we can take advantage of it post-earnings. You're not going to see us trade a day or two in front of earnings. There's too much volatility priced into that. So we're more of a follow the trend and the reaction in that direction, and only that direction. So that way you don't buy too many legs and you keep your costs down and commissions. And we focus on the big FANG names. Now, so some of our key elements here to the FANG options trader service is typically there's a catalyst. Now, for us, you can see most of the time it's some kind of technical movement. But you could say, like when that Apple 102% gain happened here a week or so, 2 weeks ago, that was a lot of hype tied to the new 10th anniversary iPhone launch that's coming out in the fall. There's a lot of people that are, Goldman came in and raised their price target. I mean, there's a lot of people that are getting excited about that. So obviously that's a catalyst, but certainly the technical action is going to be our number one catalyst on breakouts and breakdowns. If we can, we're going to go in the money, but we're not going to pay more than $10. If we have to go closer to the money and pay up to 10, we'll do it. But the higher the delta, that gives you more of a true stock substitute. Delta, if you're new to options, means, of course, how much your options moving as a percentage of your stock. So the higher the better. And the key here is that there's no arbitrary stop set. We might put out, if we're getting an initial move against us, we might put out kind of a sort of a worst case stop just to protect in case something went haywire. But for the most part, you'll see that we can just let ADX tell the tale. When ADX rolls over, we get out. So that ADX gives you your progressive trail of a stop based on the ADX line, not just on some set price of the option or the stock, but rather when the trend phase is ending. If we get a windfall gain, we've considered booking on gap, but lately our thing is, look, follow the ADX line. It's so much easier. Most every other service I've got, I book the windfall gains on a gap, at least on part of it, or sell partials. Here, you're going to see us typically just go ahead and ride that indicator. It's been working so well. So we don't have to have a target profit. We just let the indicator tell the tale. And then I do a weekly video training updates. I'm actually helping you learn while you earn. I update all the big 5 FANG stocks every week. Look at the charts, say what we've been seeing while we're making a trade or not. Like we mentioned, we've gone even further than this since March to the upside. But the overall growth, in that first phase, from 10K up to about 13,344, it'd be 33% in about 8 months, gross profit. Take your commissions into account, but it shouldn't be costing you too much, especially if you're only doing 1 or maybe 2 contracts in and out. So it's just one time in, one time out, keeping it really, really simple. Now, I want to show you, of course, we talked about the performance and the consistency and how you could actually make this an income pull. You could just be pulling those profits out of your account. One of the nice things, by the way, of pulling the profits out of your account is you get rid of that greed of thinking, I'm just going to compound this forever, and say, you know what, you could compound it. Our results there we showed you before are not compounded. It's just using a flat $1,000 a trade. We're not bumping up the allocation. We're just saying, look, if you're just using a flat $1,000 a trade, you can actually turn this into a nice income strategy as well. So since I've got a few minutes, and I'll come back in and answer some questions, but I want to show you first, how this works here. So basically, when you go to this special link that we've set up for you here, and I'll type it in the chat box if Chris hasn't already. Chris probably will, actually, so I'll let him do that. Go to bigtrends.com/FANG options trader. Before, we've usually just offered this heavily for a year, and our clients are still eating it up because of that, the results that they've seen. But what I'm going to do for you today, kind of as a TradeThirsty bonus, is, just give you a chance to try it for a month for $69 for the next 30 days. So like I said, you should get somewhere in the neighborhood of about 8 trades, give or take. Could be a trade more or less, but average about 8 trades a month. for 69 bucks. That's less than 10 bucks a trade. The more important thing is that, of course, okay, if you like it, you can just let it keep going. I'll keep honoring that rate for you every month going forward. So that way, think about it. What I just showed you is that in 8 months, we generated $3,300 worth of profits on a 10K portfolio. And really, you could do it with half of that and still have some cash left over. Because like I said, we're probably not going to have more than about 3 positions open at a time out of the big 5 FANG names. So basically, if you say, okay, the leverage potential on that money is tremendous, and you're still, even if you had it for the entire year, you're still about $800 out of pocket, give or take, 828 out of pocket, and still, if we keep that performance up, you're going to have a heck of a lot left over as your gravy. But try it for 30 days, and then if you don't like it in the 30 days, you can tell us, hey, don't let it auto renew. I don't want to stick with it. It's not for me. No problem. Basically just let us know. We tell you how to do that. I'll show you how to do that here in a second. So when you go to that page, all you got to do is just hit a real simple instruction, add to cart. But before I do that, I wanted to show you, you can see the sample gains that we've had in the portfolio. You can figure out, and those are all, it's on a typical $1,000 or less invested. Because like I said, just reminding you before, any of these times where I show you something over $5, we only used one contract. So you actually only applied like $5.35 on Netflix, $5.97 on Apple. $1,000 on Google right there. But most of them are Facebook. We would have applied almost 1,000 because $471 you get 2 contracts. That'd be $942 invested. But if it's over 5, we're only using 1 contract. So it's going to be 1,000 less is what we recommend. Just basically getting just a nice some kind of exposure to each new signal. Even if it's just 1 contract, we're fine with that. So basically, you see that when we give you the weekly recaps, we give you the real-time trade alerts, you get the unlimited email access anytime you have questions to make sure that you're following along. And like I said, you can even auto-trade this if you want to just put it on that auto-execute with a couple of the brokers. You can contact Chris for that. So when you get that add to cart button here, all you do is basically hit the green checkout because it's already there. We've already taken it down. Usually it'd be $99 a month, so I'm saving you, an extra 30% here, and I'm honoring it going forward too. So basically you're getting continuing savings. So when you hit the green checkout button, of course, that'll put you on our secure HTTPS secure server, and basically we store no credit card information in big trends. So basically just pops you through here all the information in bold you need for your credit card to process. We take all the major credit cards, and basically then you go here and you can just click, if Chris has helped you today, answer some questions, you can give him credit, put my name in there, click a webinar link, whatever suits you. Now, one of the things I want to point out is text alerts. If you want to get text alerts, it's no charge extra from big trends. We put you on a text alerts to whichever phone number that you want, okay, whichever cell phone, and then tell us, whatever that is, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 790, but then also tell us which provider you use. If it's AT&T or if it's Verizon, whatever, basically tell us, whichever one you use, and because we put them on different batch files for the text, okay? That will be no additional charge from us. Just make sure you have unlimited texting on your smartphone because we will send you an alert whenever not just we get in, but also when we get out, okay? So basically you're going to get at least 16 alerts, as well as if we need to trail any kind of a stop instruction. You're probably going to get a little more than that. Now, once you've reviewed the terms and conditions down below, which we put the full link down there, but I'll show you some of these other terms about auto renewal, since that's what this is today, is a 30 days. If you like it, just let it keep auto renewing on your credit card for just $69 in the second month, third month, etc. We have people that stay on there for years, actually. But basically, just once you review that, click on the terms and conditions, and when you're ready to go with your credit card info, you just hit submit order. You'll just be billed $69. And if you like it, in 30 days, 31 days, you'll be billed another $69. But if you don't like it, we give you a very clear cancellation policy. You can send us an email. You can fax us. You can basically give us some kind of written instruction here that you want to cancel and not be billed for any future months. Okay, so just let us know in the first 30 days. You won't get billed for the following month. And on auto-renew programs, it basically spells out all the details of that too. So we're really all about full transparency. We want you to be aware, hey, we do this to keep it simple for you and for us. And basically, if you don't like it, just tell us. We'll pull you off of the auto renew. Now, I'm going to go in and quickly answer a couple of questions. Okay, so Thomas says, do the alerts give complete details of the recommended trade, or does it refer to an email with the details? We'll give you the core instructions you need to know there, Thomas, as far as that goes. So what it looks like, for example, when we send out an email and it'll be on the alert, it looks like this. The email will say, okay, this is back the beginning of this week. We were saying right off of the open, we were saying shut down, sell to close the Google, parent company Alphabet 960 call. And so basically we were saying, okay, get out at 820 or better. Our average auto broker felt was better than that. It was 860. So we got in at 9. So essentially you get those really clear instructions about exactly how that works. Okay, Priceline is not on our list, Bill. It's not. There's no P in FANG. So basically, so all you do is you basically will get that clear instruction to get out at what price or get in at what price as part of that. So just go to that page. It's FANG Options Trader, bigtrends.com/FANG Options Trader. Chris has posted it for you. That's a clickable link. I know I got started a minute or two late, but I'm going to go ahead and keep us on time and go ahead and wrap this up and hand it back to Jeanette. But if you have any questions, at the top right of the page, we give you a couple ways to contact us. Our toll-free 800 number is easy to remember. It's just 1-800-BIG-TRENDS on your phone. Or you can email us directly to clientcare@bigtrends.com. If you have any questions about the FANG Options Trader, you want to look at that history some more, I think, I encourage you to. I think your mouth will be watering by the end of it. I just want to keep you consistent in your allocation of capital. Don't get too high or too low. Just be steady with this. I think you're going to be real pleased with the results. We make it so easy to stick with the program at $69 a month, or if it's not right for you, to just come off of it after that $69 trial effectively. So I think you'll enjoy it. Jeanette, let me hand it back to you and hope you have a great rest of the day with awesome Trade Thirsty presenters.